All right, so this is going to be our deep dive on alternative documentation income for self-employed borrowers. This is specifically for self-employed borrowers. I do want to point out it's not a separate program for non-QM. This is just an alternative documentation type. We're using bank statements, profit and loss statements, and 1099s, but these are going to be qualified under two specific matrices for our non-QM products. We're going to look at our expanded prime, as well as our non-prime matrices for these borrowers. You'll see here, there's a section for alternative documentation. Again, must be self-employed for 2 years. So these are for your self-employed borrowers. These are, sometimes we do have separate qualifying tiers depending on FICO and LTV. Right now, everything's qualifying about the same, whether it's full doc or alternative document. But just keep an eye on that when you're looking at our matrices. If you have a non-QM loan you're looking to price out, make sure you're looking at the correct income documentation type for these. Sometimes there's a few additional overlays, but right now everything's qualifying more or less the same. So this is just a quick look at the expanded prime matrix. I won't go into it in too much detail, but this is what our matrices will look like when you pull them up on our website. This is for the expanded prime. And then again, these borrowers can also qualify for your non-prime loan programs. So just a few quick guidelines that we do have for anyone using an alternative income documentation type. Again, these are eligible under our expanded prime and our non-prime programs. These are specifically for self-employed borrowers only. For that reason, we do require a business questionnaire on all of these transactions. This business questionnaire can be found on our website. Again, if you need a copy of it as well, I can send that to you. This is going to be completed by the borrower. It is going to be required on all of these transactions, and it really gives us a deep look into the borrower's business itself. We are looking for them to provide details about how many owners the business has, what their specific ownership percentages are, how the business generates income. That's actually a really important piece of this. They tell us the nature of the business, any regular expenses that they have, and then how they generate revenue. This is really important and required when we look at the bank statements themselves. When we're analyzing the bank statements to qualify, we really like to have an idea of where this income is coming from, because it's not always readily identifiable on these bank statements. It might be coming in from other sources that we don't know what they are labeled. They might get regular wire transfers. They may also come in sporadically, and that may be totally normal for the nature of this business. Maybe they only get one deposit a month, but it's large. Maybe they get only a few deposits a year, but again, that might be completely normal for this business. So really, the more information that the borrowers can give us on this business questionnaire, the better. It really does help make sure that when we are looking at bank statements, especially up front to determine your qualifying income, that we're using all eligible sources of income to qualify. We're not excluding anything that really is a source of income. And also that we're applying a correct expense ratio. For business bank statement loans, we do apply a standard 50% expense ratio across the board. But if we look at this business questionnaire and we see that they have 100 plus employees in maybe 5 different brick and mortar locations, that may be a case where a standard 50% doesn't quite do it. We may look at applying a higher expense ratio. So the more detail we can get on these business questionnaires, the better. They do need to be completed, like I said, by the borrower. They're completely fillable. It's very easy. They can fill it out on their computer. It's PDF form. So we really do want to make it as easy for them as possible to give us all this information. Another key to these alternative income loans for self-employed borrowers, the business does need to be in existence for 2 years. And we need to verify that. Typically, we can use the Secretary of State. A lot of these LLCs and corporations obviously are registered in the Secretary of State, so we can pull that. It'll show the date it's open and make sure it's active within 10 days of closing. We're also looking for proof of the borrower's specific ownership percentage in this company. They're going to list it on that business questionnaire, but we do need it verified by a third party. The two most common ways that we verify that is with either a CPA letter or if they have a recorded filed operating agreement or articles of organization that are going to show the specific ownership percentage, we can use that as well. So when you're going through these loans, when a borrower gives you a call and you think it might go bank statement, these are the two, I would say the two most important questions to be asking them is how they can verify the business exists and how they can verify their ownership percentage. Not all borrowers have CPAs and not all borrowers have operating agreements for the business. So it can get a little tricky. We want to make sure up front that we're going to be able to get all of the documentation that we need to go this route. Your qualifying income is going to be the lower of your disclosed 1003 income or the calculated income that we use from these alternative income sources. And I'll say that again because it's a sticking point. We're going to use the lower income that they either tell us they make on their 1003 or what we can qualify with the bank statements. These loans do still have ATR requirements that have to be met. And because we're not using standard documented pay stubs, W-2s to verify the income, we are putting a certain level of faith in what the borrower is telling us they make. So when you're going through the application process with them, make sure that the loan and the income that the borrower is telling us on the 1003 that your loan actually qualifies, because we don't want to get a loan into our system with a DTI of 60% because then we're more or less stuck. Unfortunately, we can't lower the income or increase the income at that point. And one good way to avoid that, if you have a borrower that you think is going to qualify for one of these loans, get the bank statements up front, get the P&L up front, whatever documentation we're using, and send it straight to me, and we can give you a qualification or a calculation very quickly. We want to make sure that these loans are going to work. We're more than happy to take a look at any documentation that you may have, to multiple bank statements, multiple accounts, multiple businesses, whatever you think the borrowers have that might work. We're happy to take a look at any of it so that we can make sure we're getting loans in here that qualify. And then all of your income documents, credit documents do need to be dated within 90 days of closing. All right, the first income source we can use is personal bank statements. Again, these are for self-employed borrowers and they do need to be self-employed for a full 2 years. We can use 12 or 24 months of personal bank statements. There's a small pricing hit for going the 12-month route. I will say it's usually the easiest. It's certainly the least documentation. It's usually only about an 1/8 difference in the rate, if there's any. Just depends on what FICO and LTV bucket you're in, if there's one at all. It's usually worth it to try the 12-month route. It's just simpler for everybody. And personal bank statements are for your borrowers who own a business. They have a business bank account, but they regularly transfer income money from their business bank account to their personal. So in this case, we are also looking for them to provide the 12 or 24 months of personal bank statements plus 2 months of the corresponding business bank account. The theory here is they are operating the business out of the business bank account. Income goes in, all the operating expenses go out of the business bank account. So anything they're transferring from the business account to the personal is pure profit for them. So we're going to use 100% of any transfers from that business account to the personal as our income to qualify. If they have a personal account, but they don't have 2 months of a business account, we can still use those statements, but they are going to be qualified under what we consider commingled funds. And we're going to apply an expense ratio in those cases similar to a business bank account, because in those cases, they're operating both their business and their personal daily operations out of that same account. We are going to look at these personal statements and back out any W-2 wages or any other large non-business related deposits, any personal transfers from bank accounts that are either are in their personal name or are not coming from this business account are going to be excluded as well. We do need all account owners to be borrowers on the loan. So if you have a husband and wife and they have a joint bank account, they do both need to be borrowers on the loan. We don't get into sourcing any other specifics other than just using these transfers, but we want anyone who's on these personal bank accounts to be liable for the loan as well. So your qualifying incomes on these is very simple. All we're going to do is take your 12 or 24-month average of all those business related transfers from the bank account and divide it by 12 or 24 months. So if you've got $75,000 a year in yearly transfers, divide that by 12 and your income is $6,250 a month. Moving on to our business and commingled bank statements. So again, this is for a borrower who maybe they don't regularly transfer money to a personal account. They only operate everything out of a business, or they have a personal account where things are commingled. We are going to use those and qualify it under this business bank account type. Again, you can provide 12 or 24 months. And these borrowers do need to be self-employed, so they do need to be at least 25% owners of the business. And I did highlight that because it is a change. Previously, for a business bank statement loan, you needed to be 50% owner of the business. Recently, guidelines have changed on that front. So we can now go down to borrowers who only own 25% of the business, which I think is great. It used to be a pretty big sticking point for borrowers to own at least 50% of the business. So now we've got much more flexibility in borrowers that can qualify using these statements. Again, we do use a standard 50% expense ratio when we're analyzing these statements. If the borrower has a CPA, and that CPA can write an expense ratio letter saying, you know, they really have much lower expenses. They work from home. They have no employees. They have no inventory. Then they can write us a letter stating what the actual expense ratio is. We can accept that as well, but we are going to use at least a minimum ratio of 10%. There's some expenses that they do have, so we have a minimum floor of 10%. And the CPA can either write a letter or they can prepare a P&L to use that lower expense ratio. It does need to be prepared by a verifiable CPA or licensed tax preparer. We are going to go and verify that that person is authorized to prepare taxes. And the operating agreement and the CPA letter, again, must verify the borrower's specific ownership percentage in the company. Non-borrowing owners of the business are going to need to sign an access letter for the transaction. So if your borrower is only 25% and there's 3 other owners in the company, we need to know who those owners are. And then we're going to get letters from all of them as well, stating our borrower does have access to this account to use for qualifying. We are going to back out any large deposits, again, or personal transfers that either look like they are not regular sources of income, or maybe they're one-time large deposits that don't recur. Again, any personal transfers that wouldn't be considered business related, so those are going to be backed out as well. Again, a qualifying income in this case is pretty simple. You're either going to take your 12 or 24-month average of all these business related deposits, multiply it by your standard 50% expense ratio or something lower if the CPA letter has been provided, as well as multiplying it by the borrower's ownership percentage. So just for example, if you've got a borrower who has $200,000 a year in business deposits, they've got a 50% expense ratio and 50% ownership in the company, their monthly income is going to be $41.66 per month. All right, moving on to our profit and loss statement. This is another option. This is great for borrowers who maybe don't have consistent deposits in their bank account. Again, maybe their income doesn't come in regularly. So we'll see large gaps with no income that makes it look like the business might not be stable. Or maybe they've changed bank accounts. They don't use the same bank account regularly, but the business itself has consistently been open for at least 2 years. Profit and loss statement can be a good option for those borrowers as well. Again, they do need to be self-employed, so they've got to be at least 25% owner of the same business for a full 2 years. And these are going to be CPA prepared audited P&Ls. So borrowers who self-prepare their own tax returns here are not going to be eligible for this option. The CPA is going to have to attest to a few different things. So they can't take their tax returns, unfortunately, to a CPA and have them write the profit and loss unless the CPA has actually prepared the taxes for them. They can prepare a 12 or a 24-month P&L. And again, it does need to be done by a licensed third-party CPA, enrolled agent, registered tax preparer. We are going to verify that via third-party sources as well, that the CPA or tax preparer is licensed to prepare taxes. And the CPA is going to have to attest to a few things. One, that they have filed the borrower's most recent business and personal tax returns. So we want this to be the borrower's actual CPA who has done their taxes and is familiar with their business, is familiar with their income situation. They are going to have to say that they've analyzed the borrower's business financial statements while they prepared this P&L, and that they are not related to the borrower or associated with the borrower's business. This needs to be a completely independent third party. We don't want them to have any relation or association with the borrower or the business. The P&L does need to be done on the company letterhead, and it can't include any language that's going to compromise the integrity of the information provided. So what does that mean? Sometimes CPAs are not willing to state that what they've given us is actually accurate. We'll see some language that essentially tries to walk back everything that they've said and attested to. That's not going to be acceptable on these. We really need the CPA to be able to take ownership of the fact that they prepared and audited and reviewed this P&L for us, and that the information is accurate. Again, we are going to verify that this CPA or tax preparer is licensed to prepare taxes via third-party sources. We'll do that on our end. And to validate the profit and loss statement that's being provided, we are also going to ask for 2 months of business bank statements for this business. So we'll look at the monthly average deposits on the P&L and on these most recent 2 months of bank statements. And we have a 35% tolerance in terms of making sure those line up. So we want to make sure that your earnings on your bank statements and the monthly average on your P&L is within 35% to essentially validate the information that's on the profit and loss statement. If we get bank statements that show 0 deposits over the last 2 months, but the profit and loss is showing $10,000 a month, that's going to be a problem. And then as long as the P&L is validated by those business bank statements, your qualifying income is pretty standard. You're just going to take the net income from the P&L, multiply it by their ownership percentage, and then divide it by your 12 or 24 months. This does not need to be a calendar year preparation, I will say. It will be just the most recent 12-month look back. So that's another advantage to using a profit and loss statement in these cases. You're not held to a calendar year. Sometimes if a borrower's income has increased over the last 6 months, obviously that won't reflect on their most recent tax return, and a lot of times it can't be used. So if you've got a borrower whose income has increased again and they don't qualify with their taxes, a 12-month P&L might be a good option for them. And then just like your regular tax returns, you can add back depreciation, depletion, amortization, and casualty loss to that net figure. All right, moving on. We also have 1099 income for self-employed borrowers that can be used. In this case, if your borrower has been a 1099 employee of the same company for a full 2 years, we're going to use just the income that's reported on their 1099s. They can provide 1 or 2 years, but they do need to be with the same company for at least 2 years. And the 1099s do need to be paid to the borrower's social security number. They cannot be paid to a company EIN or an LLC. Sometimes we'll see borrowers have set up their own company to run a 1099 through. The reason being, we do need to be able to pull the 1099 transcripts to validate the 1099 that's being provided. And usually we can't obtain those transcripts if they're paid to a company or an LLC. So these do need to go to the borrower's individual social security number. And the income is just going to be your 12 or 24 month average of the income on a 1099 less a 10% default expense ratio. So our standard ratio on a 1099 borrower is much, much lower, obviously, than a business bank statement loan. These borrowers usually don't even own their own companies. Obviously, they're 1099 employees for somebody else, so they have very low expenses. So we're going to, by default, only use a 10% ratio. If we're over 90 days from the last 1099, from the end of the year, essentially, we are also going to ask for a year-to-date pay stub or earnings statement to show that the earnings currently are still in line with those recent 1099s that are provided. And if we see any evidence of a decline, that may result in disqualification. We just need to make sure that the income hasn't declined and is still stable from the last calendar year. And all we're going to do to verify at closing is obtain a verbal VOE within 10 days, just to make sure that they are still employed with that same company. The 1099 program, I will say we see a lot. It's great for real estate agents, people, who are independent contractors, PayPal or Uber, those kinds of drivers, things like that. It's really a great option because they may write off some expenses on their tax returns that aren't always applicable, but it's a really good, easy way to qualify those self-employed borrowers. All right, just a few quick frequently asked questions that we get on these programs in conjunction with any of the sources we've talked about. So with bank statements, P&Ls, or 1099s, we can also use W-2 wages that the borrower or a co-borrower may earn from another source. We can combine those to qualify. They can be used, but they need to be documented with accordance with our full DOT guidelines. So what we'll do is provide the bank statements or P&L, then we'll provide the W-2s and pay stubs for whatever the secondary sources. We'll obtain just W-2 transcripts to validate those earnings, but we can use both of those to qualify. We can also use rental income as a secondary income source. All we need in that case is 3 months of bank statements showing the receipt of the rent going into a separate bank account than any accounts we may be using for self-employed income. So if they've got a business account that we're using and then they receive rent into a personal account, we can use both of those to qualify. Essentially, we're just going to take 75% of the gross rent from the lease to offset the payment and provide those most recent 3 months showing regular receipt of that rent to qualify. We can use up to 2 business bank accounts to qualify, whether it's for the same business or maybe they own 2 separate businesses. We can use up to 2 separate business bank accounts to qualify. We cannot use more than 1 personal account to qualify, and we can't use a combination of personal and business bank accounts to qualify. It gets a little sticky when you talk about possibly double counting sources of income when you start combining personal and business or multiple personal accounts, but we can use multiple business bank accounts. And then sort of across the board, generically, we have a cap of 3 NSF or overdraft occurrences in the most recent 12 months. When we're analyzing these bank statements, we want to make sure that the income really is stable and that they're not regularly going into the red and overdrafting the account. We can always consider exceptions, but just as a base guideline, we do say that 3 is the maximum allowed. All right, how do you submit for a bank statement loan? If you think you've got a bank statement loan, the best thing first to do is have the borrowers complete that business questionnaire we talked about and provide the 12 or 24 months of the business or personal accounts they want to use. They can provide as many accounts as they want. Again, we're happy to look at as many accounts as they think might qualify, and we'll whittle it down to what can actually be used. So go ahead and have them fill out that business questionnaire and provide that along with the bank statements to our non-QM email address. It's nonqm@maibroker.com, and we will calculate that for you. We are going to use, if it's a business account or if it looks like it's a commingled personal account, we're going to apply a standard 50% ratio at that time. If you've spoken with the borrower and you know they have a CPA that's going to be able to prepare an expense ratio letter and want to use something lower, go ahead and either let us know or go ahead and have them provide that letter if it's something they can get upfront so that we can go ahead and apply that for you as well. After that, they can also complete our non-QM worksheet and submit it again to that same non-QM email address. That's going to ask questions about the loan itself. So what's your property type? What are you looking for? A primary, purchase, rate, term, et cetera. That's going to give us all the details that we need to make sure your scenario qualifies, as well as give you some pricing details. And then if you've got we've got your income calculated. We know your rate. We know the loan works. You're ready to disclose the file. Everything follows the same process as a normal loan here at MAI. It's disclosed and submitted the same as a regular loan. All you're doing is providing those 12 or 24 months of bank statements or your P&L or your 1099s as your income. Don't provide any tax returns, any W-2s or pay stubs unless you're otherwise asked to, unless there's secondary sources of income. We don't want to see any tax returns on these loans. But other than that, it follows the same process. And we do have some resources for you on our website. A great brand new overhauled website. Under the products tab, we have a non-QM tab as well. And you'll see it shows expanded prime, non-prime, DSCR, and I-10. Those are sort of our 4 programs under non-QM. Our matrices are listed there, as well as copies of the business questionnaire and that non-QM worksheet that we talked about. But any questions you have can always be sent over to that non-QM at maibroker.com. Like I said, we're happy to take a look at any statements or questions you've got. If you've got a borrower on the phone and don't know if it's even going to work, just shoot us an email or give us a call, and we're happy to talk through any scenarios that you want to work through. All right, so I am going to stop there